Wall Street Media, this is Tyler, this is Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
Hey, we've got Superman exclusively, right?
Yep.
Rich Gordon, I love this dude. All of Wall Street loves this guy, and you're going to get a chance to see him, and he's talking about the slumping housing market.
Yep.
Beautiful slides. Technical beauty, not necessarily good beauty. Wait till you start to see some of them. Yeah, but he knows what he's doing. Let's see, watch and see what he has to say about housing.
Yep, so this is Rich Gordon. He's Wachovia Securities fixed income market strategist, and here he is talking about the slump in the housing market.
We looked at a longer-term comparative price analysis on some key metropolitan areas across the U.S., and here are a few interesting points. In the West, the price correction has hit the major metro areas of California, Nevada, and Arizona all very hard. Phoenix caught the appreciation wave later than the others, and it's suffering a sharp decline. San Francisco saw appreciation earliest in the 8-year period, but by the end of 2005, Los Angeles, Phoenix, and Las Vegas all had home prices growing at a faster rate than San Francisco. Fueled by the red-hot mortgage industry, prices in LA rose especially fast in 2004 through 2006. Right now, the real estate market is contracting sharply, but prices are still more than twice as high as they were in 2000. Of course, this isn't much comfort for home buyers in LA in 2006 and the first half of 2007. Even if they put 25% down, they've had almost all of their equity wiped out. The lack of equity means that they're largely unable to refinance, move, or borrow against the value of the home. The loss of the third household earner hits particularly hard in Southern California because they can't tap the equity like they used to. People there had been able to count on this additional source of cash flow and wealth between 2001 and 2006. In the East, the D.C. area appreciated at a much faster rate than New York, Boston, or Charlotte, but it's depreciating now at a faster rate as well. Even after the significant correction, prices in both New York and Washington are still almost twice as high as they were 7 years ago. Charlotte is holding value right now much better than the others. It's a city that didn't get the rapid appreciation that its much larger rivals had, but its continued growth has been impressive. This growth has been fueled by a large banking presence and an influx of retirees and younger people drawn to the high standard of living. In the Midwest, the appreciation in Minneapolis and Chicago has dwarfed Dallas over the past 7 years. But Dallas prices look like they've consolidated faster and turned slightly higher in the past month. Detroit has fared very poorly over the past 2 years. It's been badly hurt by the downsizing in the U.S. auto industry, and it has a less diversified economic base than the others do. Prices in Detroit are lower now than they were almost 8 years ago, and the index shows that prices still haven't begun to consolidate. Turning to commodities, one important regulatory decision the past week was that the CFTC moved to reduce some of the momentum buying in commodities and increase transparency. Commodity index mutual funds don't have order limits applied to them. As more money poured into the funds, prices skyrocketed, driving up the price of staples like food and gasoline. The de facto imposition of position limits on long-only indexed commodity funds may reduce some of the upward momentum in commodity prices, but it also highlights that going forward, increased regulatory oversight could start interfering with free-functioning markets. Also, the fact that there are more rules doesn't change the fundamental reason for the multi-year bull market in commodities prices. Emerging economies have increased the competition for available resources, and the production of these resources hasn't kept up with the increase in worldwide demand. There's a strong argument to be made that the imbalance will be there for the foreseeable future, although we'll see sharp temporary corrections as momentum investors and late longs get shaken out of deeply overbought markets.
Man, it's nice to see that detailed information and know that you can trust it, right?
Yep.
And it's not someone talking about dogs living in foreclosed homes or
no kidding.
other suspect sources, right? I actually like to be able to see this. And I thought it was amazing. You know, my wife is always telling me about housing in Dallas, and it said from 2000 to 2008, it's only gone up 20%, where in these other places it's gone up 400%, and it's still at 200 and 300% of what it was,
right.
you know. And I thought that was interesting.
Yeah, definitely.
Yeah. And I like to have it from someone that I trust, you know.
Yes.
And I trust him.
Definitely. So yeah, we'll be back in a minute with more information. Click on the feedback button. Let us know what you're buying and why. And
see us at WSMCO.com.
Exactly. Thank you very much.